Welcome everyone to today's webinar on open position management strategies in Forex trading. My name is Ali Mortazavi and I'm the head of training and education at Ranta. It's a pleasure to have you all here with us today. Before we dive into the core of our discussion, I would like to ensure that everyone can hear me clearly and see the presentation without any issues. So please take a moment to confirm the quality of both the audio and video by typing yes in the chat box if everything is working fine. If you encounter any problems, also let us know so we can address them promptly. Let me mention that in this webinar, we will explore various strategies for managing open positions in the Forex market. Effective management of open positions is crucial for minimizing risks and maximizing profits. So we will cover several techniques and best practices that can help you stay on top of your trades and make informed decisions. Very well. Thank you. Thank you so much for your feedbacks. It seems everything is working properly for everyone. That's great to know. So let's get started with understanding the importance of position management in Forex trading. Before that, let me introduce Arante, which is bringing this webinar to us. And before we dive into today's content, it's important to review our general disclaimer. The information provided in this webinar is intended solely for educational purposes, so it should not be interpreted as investment advice, recommendations, or suggestions regarding any financial instruments. This material is not designed to be a comprehensive basis for making investment decisions. And it's really important to note that trading CFDs carries a significant level of risk which may not be suitable for all investors. A considerable number of retail investor accounts lose money usually when trading CFDs. So you should fully understand the risks involved and consider whether you are prepared to accept the high risk of losing your money or not. And today's insights are meant to enhance your understanding of trading strategies, not to direct your trading actions. Okay. That said, let's take a look at today's agenda to understand what we will be covering in this webinar on managing open positions in Forex trading. The purpose of this session is to equip you with the knowledge and the strategies necessary to effectively manage your trades, minimize risks, and maximize profit through various types of strategies. We will start by defining what position management is and discussing its critical role in reducing risk and increasing profitability. Understanding this fundamental concept is essential for any successful trade. And next, we will review position sizing, which is one of the most effective methods for controlling and limiting the risk of a single position. Proper position sizing is a cornerstone of risk management in Forex trading. And then we will explore two approaches to determine the size of your position based on stop loss and risk distribution among smaller positions. We see how we can do it actually, and what is the application we need to consider before we get through using the smaller positions or let's say controlling the multiple positions in our account. This section will help you understand how to adjust your positions and manage risk effectively. And then we will also examine various common strategies using position management, such as risk-free trading or break-even trading, hedging, or scaling, let's say, scaling in and out, pyramiding, and also scalping. And these strategies can help you adapt to different market conditions and trading goals. Finally, we will have an interactive Q&A session. This will be an opportunity for you to participate in discussions, ask specific questions, and reinforce your trading knowledge. So let's proceed with our first topic, the definition and importance of position management. Okay, I would say open position management is crucial for maintaining healthy margin levels. Its primary goal is to help us adapt to changing market conditions, ensuring our strategies remain aligned with the current market environment. This becomes particularly important when trading on shorter time frames, such as the 30-minute chart. By accounting for market fluctuations, we can set more realistic profit targets and stop loss levels, as well as adjust our position sizes accordingly. This approach ensures that we do not miss out on new opportunities, which is another reason that we need to use the position management. Properly calculating trade size allows us to enhance our strategies while keeping risk at a manageable level. And this can significantly increase our potential for profitability. However, it's essential to recognize that the core value of open position management lies in our ability to control account or risk simultaneously. So for instance, imagine you have an open position in Euro USD on a 1 hour time frame and notice that USD JPY is making a strategic move on the 15-minute chart. This could present a new entry point, but this scenario raises several important questions. What should you do if your first position is at a loss? And how should you respond if your first position is in profit? And then another question can be, if you decide to open a new position, what should its correct size be? And how should you set your stop loss? You see, these are some of critical questions that effective open positions management can help answer, ensuring you're prepared to handle various market situations adeptly, let's say. So that's the reason we need to study the position sizing, let's say, management. By reviewing the method of calculating the size of a position. I'm sure many of you are familiar with this approach as we discussed it in our previous webinars in a great detail. But let's have a recap here about this because it's really important. It's the foundation of risk management in active forex trading. The first requirement for entering any position is to predetermine a specific percentage of our account balance, or let's say our capital, as our acceptable risk. This level should be something between 1% and a maximum of 5% of our capital. This means that in the worst case scenario, we won't lose more than this percentage in a single trade. And you know, what the worst case scenario for a trader is having our stop loss triggered and closing our position at a loss. Then why we calculate the distance of the stop loss from the entry point? Let's call this the pips at risk. By dividing the risk amount by the number of pips at risk, we can determine the position size. For even more convenience, we can convert this into lot size as well. Now, let's look at an example. Suppose our trader has a 100K account and wants to open a position with a tolerable risk of 2% of their capital. The stop loss is set let's say at 50 pips away from the entry point. Note that the stop loss level is usually dictated by the chart. Key areas such as the price tops and bottoms, or an important support or resistance zone. Therefore, we can't just choose any level without a technical reason. That's really important. So we consider it as a given data, okay? And then Based on the maximum position value, based on this, we can calculate the maximum position value that would be 40K or 0.5 lots. This means that if our trader opens a position of 0.4 lots and the market moves completely against their analysis, they will only lose $200 of their the 10K account. Thus, they can remain in the market and continue trading. Clearly, with this method, you would need to lose more than 40 times in a row for your account to be wiped out. And even in a market like Forex, the probability of this happening is very low. So you can say that this simple method is the most effective way to preserve your capital. To make it more clearer, let's walk through the process of calculating the position size for this trade setup as an example. The chart illustrates an example where we have identified an entry point at E, you see here, and the last market bottom is somewhere here that we are going to put our stop loss there. So based on this setup, after breaking this trend line, we are going maybe to open a buy position if the price continue to cross over the previous market top at this level. So first, let's establish our trade parameters. The entry point, or E, is at 0.60456, and the stop loss, or SL, is set at 0.59812. The distance between the entry point and the stop loss is 64.4 pips. You see here, in terms of the pip, we show it here. And next, we need to determine our risk per trade. In this example, we're willing to risk $200 on this trade as a 2% of our initial capital or our account balance. To find the position size, we use the following formula. Calculate the monetary risk per pip, which means the risk amount divided by pips at risk will give us the 31,055 units of the base currency. It doesn't matter what currency pair it is. So this means that given our stop loss distance and a risk tolerance, which is $200, we should open a position of 0.31 lots. Now, let's interpret this position size or in terms of risk management. If the market moves against our position and hits the stop loss, we will incur a maximum loss of $200. And this is because we have calculated the position size to ensure that this is the maximum amount we are willing to lose on this trade. By adhering of this method, you can maintain our we can maintain an overall risk management strategy, ensuring that our losses are contained within acceptable limits. Also, this approach helps us stay in the market longer, preserve our capital, and continue trading even if we encounter several losing trades in a row. And because of all of these reasons, we can say proper position sizing is a fundamental aspect of successful trading, helping us balance potential rewards with the risk involved. Now we aim to develop a multi-position system based on this approach. Understanding how to effectively manage open position is the key to maintaining a robust and resilient trading strategy. The fundamental principle here is to enhance flexibility while keeping our risk exposure within predefined limits. So firstly, we calculate a maximum acceptable risk level for our entire capital. This is usually a small percentage, typically between 1% and 5%, let's say. At last, depending on your risk tolerance and trading strategy, and also, of course, the capital you are holding in your account. For example, with a 10K account, we might decide that we do not want to risk more than 2% or $200 on any given day or trade setup in whole. Okay, and then having established this maximum risk, we then divide its amount among multiple smaller positions. This is akin to not putting all your eggs in one basket, right? So if we plan to open 4 positions, we can allocate, let's say, 0.5% of our capital to each position, ensuring that our total risk exposure remains within the acceptable 2% limit. This way, the failure of any single position does not significantly impact our overall portfolio. For instance, if we lose $50 on one trade, let's say 0.5%, we still have a 1.5% left to allocate across other trades. Next step is that we need to consider the correlation between different instruments. If you have already opened a position in your USD, opening another position in USD CHF might expose us to similar might expose us, for example, in GBP USD, might expose us to similar market movements due to their positive correlation. Instead, selecting an instrument like, let's say, for example, AUDJPY, the Aussie yen, which has a different correlation pattern, can help us better diversify our risk. And this approach ensures that losses in one position are not amplified by similar movements in another. And the next step is, when determining the size of each position, we base it on the remaining risk from our maximum acceptable capital risk. This method, let's say this method and this approach ensures that our free margin remains aligned with our risk management strategy, automatically helping us avoid margin calls. For example, if we have already risked 1% of existing trades, we have 1% left to risk on new positions. And this not only protects our capital, but also maintains our ability to seize new trading opportunities without overextending ourselves. And last but not least, we have the fact that by setting multiple take profit levels for positions in the same instrument, even if we open all the positions in the same instruments, we can enhance our strategy's flexibility, more aligned with the market fluctuations. This means that while one position might close at a nearer profit target, another might remain open to capitalize on further market movements. And for instance, you might set the first take profit level at a nearby resistance level and a second, more ambitious target further away. This approach allows us to lock in profits incrementally and manage our exposure to market volatility more effectively. By implementing these strategies, we can maintain a balanced and flexible trading approach, ensuring that our risk is well managed and our capital is preserved for further opportunities. This systematic approach to position management not only helps in maximizing profits, but also in minimizing losses, thus contributing to the overall efficiency and success of our trading system. So this is one way, but let's delve into the first of our 5 strategies for managing open positions, starting with the break-even strategy. This approach involves adjusting the stop loss to the entry point under specific conditions, effectively eliminating the risk of loss once the trade is moved favorably. So let's see, what is a break-even strategy. The break-even strategy is a risk management technique where a trader moves the stop loss to the entry point or slightly above once the price has moved a certain distance in the trader's favor. By doing this, the trader ensures that if the market reverses, the position will close at the entry point without incurring a loss. So this strategy helps protect capital while allowing the trade to potentially reach its profit targets. Delve into practical steps of implementing the break-even strategy in forex trading. This is a key technique for managing your open positions and protecting your capital. Let's walk through these steps in detail. First, we need to determine our entry point. This is the price level where we decide to enter the trade. It should be strategically chosen based on, let's say, a thorough analysis. For instance, if you've identified a strong support level and the price is approaching it, you might decide to enter a long position. Conversely, if the price is nearing a significant resistance level, you might enter a short position. And this decision should be informed by your technical analysis, which might include indicators, chart patterns, or fundamental factors. Next, we set our initial stop loss. The stop loss is a crucial tool for risk management as it protects us against significant adverse price movements. Typically, we place a stop loss at the technical support level if you're going long, or a resistance level if you're going short. For example, if you enter a long position at 1.20, you might set your stop loss at 1.1950 below the support level. And this ensures that if the market moves against you, your losses are limited. Step 3 is monitoring price movement. Once the trade is live, it's essential to closely monitor the price movement. This means tracking the price action and ensuring it moves in the direction you anticipated. This step requires and may involve adjusting your analysis as new information becomes available. Keeping an eye on the price movement helps you stay informed about how your trade is performing relative to your expectations. And then the final step in this strategy is to move the stop loss to the entry point once the price is moved favorably by a predetermined amount, such as, let's say, 5 pips. Let's say the price has moved from 1.20 to 1.2050, say, in your favor. In this case, we have a 50 pips, okay, move in our preferable direction. So you would then adjust your stop loss from 1.1950 to 1.20 by doing this. You ensure that if the price reverses, your trade will close at the entry point, resulting in no loss. This step is crucial as it locks in a risk-free position, allowing you to focus on potential gains without worrying about losing capital. And in that case, you can also, let's say, close a part of your position. Means you can go through the multiple positions at one instrument with different take profit levels. And then when you see that the price is reaching your targets, let's say your first target, and that case you can just realize part of your profit and then move your stop loss for the whole trades to your entry points, because in that case you have unrealized profit from your open positions, and when you realize part of this profit, it means if everything even change unprofitably, so in that case you may not lose anything, any cent of your capital. And this is the magic of protecting your capital using this strategy. So let's talk about its advantages. By moving the stop loss to the entry point, you effectively eliminate the risk of loss on that particular trade. This strategy allows you to secure your position and protect your initial investment. If the price continues to move in your favor, you can still capitalize on the gains. However, if it reverses, your stop loss at the entry point ensures you break even, thereby safeguarding your capital. Another advantage of this method is a mental peace. One of the significant benefits of this strategy is the psychological relief it provides. Knowing that your trade is protected from loss can significantly reduce stress and anxiety. This mental peace helps traders stay disciplined and make more rational decisions. It's easier to stick to your trading plan and execute the strategies effectively when you're not constantly worried about losing money. However, this method, like any other strategy, is not without its limitations. It's really important to remember that one of the main drawbacks of this strategy is the potential for premature closure. Let's say if the price briefly touches the entry point before resuming its original direction, the position may close too early, causing you to miss out on potential profits. And this is a thing that can usually occur in short-term trades. For example, if so, implementing this strategy on 1-minute chart is not recommended. Okay, and the second one is that the strategy may be less effective if the entry point is near a significant support or resistance level, where price fluctuations around these levels can trigger the stop loss, leading to frequent break-even closures. Uh, Let me explain it through an example. Imagine you have entered a long position in your USD at 1.20 with an initial stop loss at 1.1950, risking 50 pips. Okay, so the price moves favorably and reaches 1.2050, a 50 pip gain. At this point, you decide to move your stop loss to the entry point of 1.20. If the price reverses to 1.20, the trade will close at break even, protecting your capital. However, if the price continues to rise, you can capture additional gains without any risk to your initial investment. So you see, by employing the break-even strategy, you effectively manage your open position, protect your capital, and reduce psychological stress. And this strategy is particularly useful in the volatile markets where price reversals are common. It allows you to stay in the game longer and giving your trades the potential to reach their profit targets without the fear of uh, incurring losses. So as we proceed, we will explore additional strategies for managing open positions, each offering unique advantages and considerations to help you optimize your trading performance. So far, if you have any question, please write it down through the chat box. Very well. Now, let's explore the second strategy of managing open positions, the doubling position strategy, also known as averaging down. This strategy involves increasing the size of your position when the market moves against your initial prediction. Let's see, what does it mean? The doubling position strategy is employed when a trader decides to increase the size of their existing positions, particularly when the price moves contrary to their forecast. By doing this, the trader aims to improve the average price of the position. This means that even a small movement in the desired direction can quickly turn the trade into a profitable one. Uh, let's take a look at the implementation steps of this strategy. We need to begin by thoroughly analyzing the market to confirm that the initial trade direction is still valid. Guys, this is the uh, the most important part of this strategy. We need to see that our analysis about the market, about the initial trade direction, is still valid. This involves technical and fundamental analysis to justify the decision to double down. Okay, then we need to calculate the new position size. Determine the size of the additional position you need to open. This usually involves doubling the size of the existing position to effectively bring the average entry price closer to the current market price. And then we need to execute the trade to double our position size. For example, if your initial position was one lot, you now open an additional one lot, making your total position size two lots. It's something similar to martingale strategy, but it's a bit different because first of all, we don't do it blindfold. We really need to make sure that our initial technical analysis or fundamental analysis about the market direction is still valid. And then we take advantage of any of these price falls to, let's say, to lessen our average price entry. Okay, then after adjusting your position size, it's crucial to re-evaluate and set your stop loss and manage the increased risk. During all of these levels, we don't change the risk level of our initial capital, which means we need to have some free margin in advance to be able to implement this strategy. So the new stop loss should protect your capital while allowing enough room for the trader to move favorably. This method has, of course, advantages. By increasing the position size, the average price of your position improves. This means that a smaller price movement in your favor is needed to reach break even or, let's say, profit of your overall two trades. No, you can have a profit from the second trade and a loss from the first trade, but eventually, or you can just get to your break-even point, which your total profit and loss is zero. So you can reach out before reaching the previous entry point, and that's very important in case you think that's, let's say, it usually happens when we see a very strong market zone of resistance or support, that you might see the price fluctuations around that key level. So in that case, you might make sure that the price will not get through that resistance again. So you better just lower your average entry price by taking another position at the lower price and then wait for a break-even point to close all of your positions and to just, let's say, reduce the risk of your capital. So since the average entry price is closer to the current market price, it takes less of a move in a desired direction for the position to become profitable, potentially leading to quicker returns. However, we have to be aware of its limitations. First is a high risk. This strategy significantly increases your exposure and risk. If the market continues to move against your position, losses can accumulate rapidly. And the next one is it requires larger capital. Doubling the position size requires sufficient capital to maintain the increased margin requirements and to withstand potential drawdown. So you have to have a solid, very, very significantly solid stop loss level, and you have to predetermine your risk level and your position size, and even enter with a fraction of your allowed position size if you are thinking of using this strategy. Let me make an example here. Imagine you entered a long position on Euro USD on 1.20 with a one lot size. However, the price drops to 1.1950, moving against your prediction. Okay, after analyzing the market, you are still confident in your initial forecast. So you decide to double your position size by adding another one lot at 1.1950. Your new average entry price would be closer to 1.1975, okay, to some point in the middle. Now, if the price moves up to 1.1980, you are much closer to a break-even point compared to the initial entry. This strategy can be beneficial when used wisely and carefully, and ensure that you have enough capital to support the increased position size. And the next strategy is pyramiding strategy. All right, let's discuss the pyramiding strategy, a powerful tool for maximizing profits during a sustained trend. This is my favorite strategy, to be honest. This strategy involves gradually adding smaller positions to an already profitable position as the trend continues, whether it's upward or downward. The objective is to leverage the momentum of a strong trend, amplifying your gains without taking an excessive initial risk. Imagine building a pyramid, okay? Your initial position forms the broad base, and each subsequent position adds a smaller layer on top, increasing your exposure in the direction of the trend. So let's take a look at the implementation steps. First, we have determining the initial position. To start, you need to identify and enter an initial position based on a thorough analysis and a clear trend signal. You see, guys, this is a risk management strategy. It has nothing to do with the trading strategy based on technical analysis or fundamental analysis. You have to try to master that part as well, but this is all about just let's say managing your open positions. In that case, we assume you have a thoroughly analyzed market, and that's case you have chosen properly your entry, stop loss, and take profit levels. For example, suppose you have been monitoring the Euro USD currency pair and notice a confirmed breakout from a key resistance level. You decide to enter a long position at 1.10. This initial position serves as the foundation of your pyramid. In step 2, you need set levels for adding new positions. Next, establish specific price levels for adding new positions. These levels are determined using technical analysis tools such as Fibonacci retracement levels, moving averages, or other support and resistance zones, you name it. The key here is to ensure that each new position is smaller than the previous one, maintaining a structured approach to risk management. For instance, after entering the initial position of one lot, you might plan to add a second position at 1.1050 and a third at 1.11, each smaller than the last. Let's say these levels are at a bit above a strong resistance level or a Fibonacci retracement level. In that case, you can capitalize your position size by adding a smaller amount, by adding a smaller sizes through passing these further resistances. And next, you need to manage the overall position together. It's really important to let's say take care of the whole position simultaneously. What does it mean? It means continuous monitoring and management of the entire position is the crucial part here. Just stop losses for each layer to lock in profits and minimize exposure to potential reversals. This is one step we can take. For example, after adding the second position at 1.1050, you might move the stop loss of the initial position to 1.1025 if that's a technical level to secure some profit, okay? And this ensures that even if the market reverses, your overall risk remains controlled and your gains are protected. Let's mention some of the advantages of this strategy. Pyramiding enables you to amplify profits by leveraging the prevailing trend's strength by adding to your position as the price moves favorably. You capitalize on market momentum without taking on excessive initial risk. This strategy allows you to build on your success layer by layer, maximizing your returns from the trend. And the next advantage of that is starting with a smaller initial position and gradually increasing exposure helps you maintain control over your risk. Each new position has its own stop loss, reducing the likelihood of significant losses from any single reversal. This structured approach to scaling into trades ensures that your risk remains manageable even as you increase your exposure. And this is the magic, guys, here. You know, if you are familiar with trading Forex, you know that's why we are going with smaller positions, because when you have a profitable trade open, okay, uh, you will see with adding profits, unrealized adding profits, you see your equity is increasing. In that case, means your free margin is increasing. So it means you might get this signal that your margin level is increasing higher and higher, which is a very, let's say, a very gauge of the health of your account. And that might be misleading for us as a trader. That's why we have to consider the fact that our next positions should be smaller than the previous ones. In that case, we don't get, let's say, misled by increasing free margin levels. And then we will be able to manage our risk and our exposure to the market and that instrument altogether. But let me also mention some limitations of this method. One of the primary challenges of pyramiding is the risk of rapid trend reversals. What does it mean? It means if the market suddenly changes direction, the added positions can quickly turn profitable trades into losses. Therefore, it's essential to have a well-defined exit strategy and stop loss levels for each layer. Always be prepared to act swiftly to protect your capital. And also, one other strategy that you can apply with this is to somehow, let's say, to set closer take profits for your initial entry, or let's say for your first position. In that case, you can exit the market faster than usual while you have added more positions, so you have added more profit. In that case, you can reach your target profit, but in closer levels. You don't need to wait for the market for a long time, especially if it's close to, let's say, news announcement, or it's close to the end of the session, or there is something uncertain about the market that's going to happen in the near future, and you have this trade to stay in the market. In that case, you can use this strategy to manage all of your trades together, and also to manage your take profit levels and exit the market at let's say satisfying level of profits, but sooner than expected. But it's worth to mention that pyramiding requires constant vigilance and precise monitoring of market conditions. You need to be attentive to price movements, trend strength, and potential reversal signals to effectively manage your positions. This strategy demands discipline and careful planning to ensure that the additional positions contribute to overall profitability without exposing you to undue risk. Let's say you've identified a strong upward trend in the Euro USD currency pair. Okay, let us get back to our initial example. You enter an initial long position at 1.10 with one lot. As the price moves to 1.1050, you add a second position of 0.5 or half a lot. Okay, when the price reaches 1.11, you add a third position of 1.25 lots. Each time you add a new position, you also adjust the surplus levels of the previous positions to lock in profits and protect against reversals. This method allows you to maximize your gains by building up on a winning position while controlling risk through smaller, let's say, incremental additions. By setting a stop losses for each layer, you ensure that even if the market reverses, your overall risk remains manageable. And this is the magic of this strategy. The pyramiding strategy can be highly effective in trending markets, allowing you to take full advantage of strong price movements. However, it requires discipline, careful planning, and let's say continuous monitoring to ensure that the additional positions contribute to overall profitability without exposing you to undue risk, as I said. So by understanding and applying the pyramiding strategy, you can enhance your ability to capitalize on sustained trends, making the most of your trading opportunities while managing your risk effectively. One of the instruments that I say works very nicely with this strategy is USD/JPY. If you look at the USD/JPY chart, especially the 30 minutes and 1 hour chart, you see usually when the market is getting into a new trend, it continues without a breather, without any stop. In that case, you have a very strong momentum and you have all the indicators let's say pointing at the accelerating market momentum. In that case, you can't find a new entry point, or it's, let's say, really hard. In that case, using these types of a strategy like pyramiding a strategy kind of work very well and properly with those instruments that you don't want to miss any maybe trade. So as we move forward, we'll explore more strategies for managing open positions, each with its unique benefits and considerations to help you optimize your trading performance. So it's really important, guys, that you have to implement these strategies based on the market setup, based on your overall knowledge and confidence about the market trend. Okay, don't use them blindfold. That's the thing. Okay, all right, now let's dive into our fourth strategy for managing open positions, which is hedging. You might have heard hedging a lot. Think of hedging as a buying insurance for your trades. It's a method to protect your portfolio from adverse price movements by opening a position opposite to your current one. But it's really important to do it properly. Hedging is a risk management strategy where you intentionally open a position that opposes your current active position. The main goal here is to mitigate potential losses from unfavorable price movements. By doing this, you effectively balance the risk, ensuring that any losses in one position are offset by gains in another. But we have different types of hedging in Forex. One of them is a direct hedging. What is direct hedging? This involves opening a new position that directly opposes your current position in the same currency pair. For instance, if you have a long position in Euro USD, so you would open short position in the same pair, the Euro USD, but in the opposite direction. So this way, if the price moves against your initial trade, the hedge helps limit your losses. The next one is indirect hedging. In this approach, you open a position in a different but correlated currency pair. For example, if you're long on Euro USD and notice that GBP USD often moves in the same direction, you could short GBP USD. This indirect approach helps manage risk without directly opposing your initial position. And another one is using other financial instruments. You can also hedge your positions using other financial instruments or financial tools like options, futures, or CFDs. For instance, buying let's say, cryptocurrency like a Bitcoin in a crypto exchange, then you can protect your long position by maybe short Bitcoin CFD in a Forex broker. This is a one way to, let's say, to hedge against the market. But before we get into how we should do that, uh, let's break it down into a couple of steps. Okay, first is determining the initial position. This is, you see, we always start with this step, which because the first position is the most important step we have to take before we go through any of these, let's say, position management strategies. Start by setting up your initial trade based on your market analysis. For example, let's say you are long on Euro USD because you expect the euro to strengthen. And the next step is setting levels for adding new positions. Decide at what point you will add the hedging position. This could be based on market volatility, technical indicators, or significant economic events that might affect the market. Then you need to add new position when the conditions are met and you should go to execute your hedging trade. For instance, if the market starts moving against your long Euro USD position, you might open a short position in GBP USD to protect your overall portfolio. And the step 4 is managing the overall position. Keep a close eye on both the initial and hedging positions. Adjust your trades as necessary to ensure that the hedging position effectively offsets potential losses from your initial trade. This might involve, let's say, tightening stop loss levels or closing the hedge if the market stabilizes. This method has some advantages, mostly depends on how you use it. But let's say hedging acts like safety, not for your trades, okay? You have to remember this. By balancing your positions, you can protect yourself from significant losses, allowing you to stay in the market with greater confidence. But hedging is not going to, let's say, increase your profits. It's just like insurance. You're paying insurance for all your life, but you think you might use it maybe once in your life, but that's where you really need it. So the hedging allows you to stay in the market only with greater confidence. It doesn't help you to make profits with hedging. You can just stay in the market. And one of the key objectives of hedging is to maintain your margin level at a stable rate. This is the most important, crucial part of let's say hedging a strategy. For example, if you have a long position in your USD that starts to lose value, opening a short position in GBP USD can offset the loss. While the Euro USD position may be in the red, the profit from the GBP USD short position helps balance your account, keeping your margin level steady despite the price fluctuations. And that helps you to stay in the market. And that brings us to flexibility. This strategy offers the flexibility to maintain your market exposure while managing risk. It enables you to navigate through volatile market conditions without being overly exposed to sudden adverse price movements. However, you need to take into consideration the limitation of this method. Hedging isn't free. It comes with additional costs like spreads, commissions, and the cost of options premiums if it's occurring in other markets that other than forex market. These can add up and eat into your profit. So it's essential to weigh these costs against the benefits of hedging. The first thing. But however, by Aranta, you can find the cost of hedging. For example, you have a 50% margin required margin level for hedging. That's the one thing. And you can have a hedging account with Aranta, which allows you to open opposite, let's say, positions on one instrument at the same time. The other, let's say, limitation of hedging strategy is its complexity. Let's say implementing a hedging strategy requires a thorough understanding of market dynamic and continuous monitoring. So you need to be on top of your game, adjusting positions as the market evolves, which can be quite complex and maybe time consuming. So it is recommended for those who are active traders, staying in the market, looking at charts for hours, and they are just behind their desk all the day. Let me put it into an example. Let's say you have a long position in your USD at 1.20, okay? Because you expect the euro to strengthen against dollar. However, market conditions become volatile and you want to protect your position. You could open a short position in GBP USD, which tends to move similarly to Euro USD. If Euro USD drops, your losses on the long position may be offset by gains in the short GBP USD position. This hedge helps balance your risk and protect your portfolio from adverse movements. Moreover, the profit from the short GBP USD position compensates for the loss in the Euro USD position, thereby keeping your margin level stable. So this stability ensures that you do not face margin calls and can continue trading without undue stress. But here is the very, 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 very important note. Contrary to the common belief that hedging should be done when a position is already in loss, it's actually more effective to hedge to prevent losses. By opening a hedging position preemptively, you can safeguard your trades before they turn negative, ensuring that your portfolio remains balanced and your capital protected. So, in conclusion, hedging is a powerful strategy for managing open positions, especially in uncertain market conditions. One thing you can take into consideration also is that it's very, very, very useful strategy when you have a long or short position on a higher time frame. For example, let's say I'm short on Euro USD on daily time frame, because I think eventually the overall market events in this week may impact the euro in a case that it's going to weaken it's going to weaken against dollar. So I'm short on euro USD on daily time frame. On the other side, I see some fluctuations in the market causing the price moving up. Okay, and that can causes two things. First, I might see my profits are shrinking. That's the first. Or worse, I can see my losses growing. Okay, from my short position on euro USD on daily time frame. In that case, if I want to manage my position, I want to manage my risk exposure, or let's say my margin level, because eventually I need to have enough margin to cover my position, to hold my position if I want to reach my target. That case, I'm going to hedge in a shorter time frame, let's say GBP USD, which has a almost positive correlation with Euro USD, and I'm going to open a long position on GBP USD on a shorter time frame with predetermined take profit levels and stop loss levels. In that case, by making some profits from the short-term fluctuations in the market, I will be able to keep my longer position open, and I will be able to safeguard my capital against these short-term fluctuations. This is the most proper way of using hedging strategy when trading Forex. Now, let's explore the fifth and final strategy for managing open positions, which is called scalping. I guess you are all familiar with scalping. You know, scalping is a short-term trading strategy designed to profit from small price movements. This method involves making numerous trades throughout the trading day to accumulate small gains that add up over time. Okay, but let's define it a bit and talk about it. Scalping is a high frequency trading technique that focuses on taking advantage of small price changes. So the goal is to enter and exit trades quickly, capturing minor price fluctuations and accumulating profits from multiple trades. Scalpers aim to make many trades in a single day, often holding positions for just a few minutes or even seconds. But let's take a look at the types of scalping. We have different types of scalping. One of them is market scalping. This involves taking advantage of the bid-ask spread. Scalpers place trades to profit from the small differences between the buying and selling prices in the market. So they usually play it on a very large position sizes. Okay, then the next one is trend-based scalping. This method follows a prevailing market trend. Scalpers identify the trend direction and place trades in the same direction, aiming to profit from short-term price movements that align with the trend. The very famous trading strategy using this method is getting reversals at 1 minute time frame. It's a really let's say the common way. I will get through it maybe in our upcoming webinars. Okay, so the other one is a let's say it's called counter trend scalping. This approach involves trading against the current trend. Scalpers look for short-term price corrections or pullbacks within a larger trend and place trades to profit from these temporary reversals, which means, for example, looking for a market correction during a strong trend. If the market is trending upside, so any resistance level can be an opportunity for a sell trade or opening a sell position, because we usually expect to see a minor correction at those let's say resistance levels. And that's the way that's counter trend scalpers just jump on the market to play these scenarios. But let's take a look at the implementation methods of scalping. First, we need to begin with a thorough market analysis to identify potential trading opportunities based on our scalping strategy. So in that case, we can use technical analysis tools such as moving averages, trend lines, and price action patterns to determine the best entry and exit points. And then we clearly outline our entry and exit strategies. Set precise criteria for when to enter a trade, such as specific price levels or technical indicators, and establish exit points to lock in profits or minimize losses. That's it. And then we need to know that scalping requires a meticulous position management. Continuously monitor your trades and adjust your stop loss and take profit levels as needed. So the goal is to ensure that each trade adheres to your predefined risk management rules. Okay, so if we can play during a scalping method, we can play with all of these let's say those other open position strategies we discussed. Okay, we can play all of those scenarios based on the market setup. That's the reason can give some advantages to scalping method. Scalping allows traders to quickly accumulate profits by capturing small price movements. Scalpers can build up their earnings throughout the day. Okay, and also the other advantage is risk management. Due to the short duration of trades, scalpers can effectively manage their risk exposure. They can play many different open position strategies, and each trade is typically low risk, and strict stop loss levels help limit potential losses. However, we have to consider the limitation as well. One of them is a high trading cost, because the frequent trading associated with scalping can lead to high transaction costs, including spreads and commissions. So these costs can significantly impact overall profitability. So you need to have a look at your potential costs if you want to play scalping scenario. Okay, and the other limitation that was to mention is high stress and pressure. Scalping is a fast-paced and demanding strategy that requires constant attention and quick decision making, so it may not be suitable for everyone. The high pressure environment can be stressful, making it challenging for some traders to maintain discipline. So I would say scalping can be highly effective for traders who thrive in a fast-paced environment and have the discipline to manage their trades precisely. While the strategy offers the potential for quick profits, it also demands rigorous attention and swift execution. By understanding and applying the scalping strategy, you can enhance your ability to capitalize on short-term market movements, adding another valuable tool to your trading arsenal. Okay, I think we got to the end of this session right now. So if you have any question, I would be more than happy to answer that. Please write it down through the chat box. Then let me just check if you have any question. Okay, I see a couple of questions here. The first one is, how does market sentiment affect the management of open positions? Oh, that's a great question. I would say market sentiment, or the overall attitude of investors towards a particular market or asset, can significantly impact how you manage open positions. If sentiment is bullish, traders might be more inclined to hold or increase long positions. Conversely, bearish sentiment might prompt traders to close or hedge their positions to mitigate potential losses. We need to monitor these sentiment indicators, such as the fear and greed index. This is one of the tools that can help traders make informed decisions about managing their position. And then, if you see the sentiment of the market is changing against you, it's better to, let's say, try the break-even strategies, which can be very useful to minimize the losses. That's a good way. Okay, so and of course, the measuring the market sentiment using the many techniques through, let's say, price action, like the candlestick charting, or let's say using these indicators or quantitative methods as well, looking at some market data and the events that can impact adversely the market. All of them can help you to implement your next open position strategy. Okay, the next question is, what role does leverage play in managing open position? That's a very great question. Yes, leverage allows traders to control a large position with a relatively small amount of capital. We know that, but we should consider the fact that it magnifies both potential gains and losses. When managing open positions, it's crucial to be aware of the leverage ratio used. So high leverage increases risk. So traders need to be more vigilant with risk management techniques, such as setting tight stop losses and regularly monitoring positions. But we have to keep in mind that over leveraging can lead to significant losses and margin calls. But the technique that I learned you about position sizing, you can use it no matter what level of leverage you are using. That techniques can help you to protect your account forever. And by using that technique, you will not never face the stop out. That's a proof of fact. That's not what I claim. So play the leverage using the right position sizing. Another question is about, let me check. What is the importance of diversification in managing open positions? Yeah, very good question. I would say diversification involves spreading investments across different assets or markets to reduce risk. Okay, this is a core philosophy of diversification. In managing open positions, diversification helps to mitigate the impact of adverse movements in any single position. For example, holding position in multiple currency pairs or different asset classes can balance potential losses in one trade with gains in another. Okay, this approach reduces the overall risk of the trading portfolio and can lead to more stable returns. Hedging strategy can be somehow be looked as diversification, one of the diversification strategies as well, when you are going to for indirect hedging or using the other financial instruments to hedge against your initial position. The other question is a very great question. Is how do you decide when to close an open position? Wow, that's a very good question. I would say deciding when to close an open position involves several factors. Okay, first is profit targets. If the trade reaches your predefined profit targets, it might be wise to close a position to lock in gains. That's it. For example, you might mark a level like let's say the resistance or support level. As soon as the market reach that level, it's better to close the position. The next one is the stop loss level. If the price hits your stop loss, close the position to limit losses as planned. It's highly recommended. And then you need to look at the market conditions. Changing market conditions such as trend reversals, let's say increased volatility or news events might prompt you to close a position early because you might see the sentiment has changed against your initial analysis. In that case, you better to cut losses by closing a position early. And another thing that you can use the technical indicators. They signal, let's say the signal that technical indicator generates, like moving averages or RSI, they can suggest it's time to exit a trade. For example, by following a well-defined trading plan and staying disciplined, traders can make objective decision about when to close a position. Okay, that's it from my side. For now, the last question, because we are out of our time, is that's how does trading psychology impact the management of open positions? I would say trading psychology plays a critical role. We all know that, especially in managing open positions. Emotions like fear, greed, and overconfidence can lead to impulsive decisions, such as holding on to losing trades too long or closing profitable trades too early. We all have faced these, we all have experienced this, I guess. Maintaining a disciplined approach, sticking to your trading plan, and managing stress are essential for effective position management. So techniques such as mindfulness, journaling trades, and taking breaks can help traders maintain a healthy mindset and make rational decisions. And all of these approaches aim to keep you with your position management rules, which means, for example, if you use a partial take profit, if you use a break-even position management, you will be able to overcome part of your bad feelings, which are trying to control you, and that might end up in a very bad result for your trade. Okay, so those position strategies can help you to control the psychological impact of the of market movements. Okay, I think we have some similar questions as well. I think we have covered the most. We have reached the conclusion of today's webinar, Managing Open Positions in Forex Trading. I want to thank you all for your active participation and engagement throughout this webinar. With that, we conclude today's webinar. Have a great day, and I look forward to seeing you at our next session. Goodbye, take care, and have a great evening.